semi-viral thread on Twitter. Somebody named Tyler Tringus. He's an early stage investor. Don't know who that is, but he did a thread predicting A16Z was a zero interest rate phenomenon and an incredible machine to accumulate AUM, assets under management. And so what were your thoughts?
I mean, I think it's a little unfair. I think this was written more just to try to generate views and clicks because you have to see the underlying return data to really have a sense of knowing. I think it's fair to say a couple of things, that there was probably 2.5 or 3 years of capital raised in the industry that's going to get really put under pressure. And the reason is that there is not a lot of time diversity in that money, meaning people got it and they put it into the ground right away. And one of the principles of having a more predictable set of returns over time is that you leverage time, right? So if you had $100 and you wanted to have a diversified stream of returns, you're much better off spending $1 a month for 100 months versus $10 a month for 10 months. So just that thing will cause a lot of impact and headwinds for a lot of the capital in 2021 and 2022. Then the other thing you have to keep in mind is that over many cycles where we've had high rates and low rates and medium rates, our industry typically returns $1.60 for every dollar it raises. And that's over many cycles. And so if you believe that we're going to revert to the mean, out of the $1 trillion we've raised, maybe we'll return 1.6 trillion. Now that sounds good, except the problem is that 1.6 trillion is marked at 5.5 trillion. So you're going to have to give back.
So there's a lot of pain.
You're going to have to give back a lot of paper profits in order to get back to that 1.6 and be okay with it. And the question is, what has happened in decision making in the meantime? Meaning, how many people did you hire? How many deals did you do that you regret? And then how does it change your psychology and how you treat the next investment that comes over the desk? Can you separate yourself from these bad losses and not be on tilt and make a good decision?
So you had a terrible 2-day session like Phil Hellmuth did last week, losing $350,000. Can you play the next week and not be on tilt and start to build back your stack and make $30,000 a night for 10 nights or 10 of the next 15 sessions or whatever it is? Sachs, you had a rebuttal or something you wanted to add to this?
No, not really a rebuttal. I mean, look, I think if you're going to be intellectually honest about it, I think that 2021 is going to likely be not a great vintage for VC. Why? Because the valuations were just really high. They've come down by at least 50% on average, maybe more. Maybe more.
I mean, 50% now, but you still have more medicine to take, I think, when you look at some of the businesses.
But, a lot of these companies are growing into their valuation. Look, I think for any given set of companies, for any portfolio, the most important thing is what's in the portfolio. So if in 2021 you had the founding of the next Google or whatever, that effect is going to swamp the effective price levels in that year because of the power law. Again, the number one most important thing is just what's in that portfolio, what's in that basket. The second most important thing is the entry prices. And obviously, if the entry prices are twice as high in a given year than they are in every other year and twice as high as what the exit multiples are going to be in 10 years when that portfolio becomes liquid, that's going to hurt the returns. But we won't know which of these effects predominates until 5 years from now when we see,
more. Yeah. I mean, when I saw that tweet thread, I thought maybe this is an issue for some venture firms, but we're not going to see even the inklings of it for another 5 or 7 years.
Takes a while, yeah.
That's a problem that may manifest itself in year 10. And between now and then, any firm that has a good track record of returning capital, or frankly has a good brand and good marks, will still raise an inordinate amount of money because this is an asset class that I still think on the margins is a more of a must-have asset allocation than on the margins, I'd just rather ignore it because it is the future of how GDP will get created. And so everybody kind of has to pay attention.
Imagine if in 2021, the next great mega outcomes in AI were created, right? Because those founders were just slightly ahead of the curve. They were like a couple of years ahead of the curve. If those create, the next, $1 trillion companies.
Google, Apple.
then the
Uber,
fact that price
whatever.
levels were 2x what they should have been won't matter.
Yeah.
What'll really matter is the distribution. There'll be a bunch of bad portfolios, and there'll be some really incredible ones. And that's the way it always is with venture.
The thing to keep in mind is in 21 and 22, rates were still effectively too low. And I think we did this analysis, Nick, you can throw up that thing, but it's not correlated with big outcomes. Those vintage years. 2023 is the first vintage year where we're actually starting to see high enough rates that have historically generated that kind of return. And so I do agree with you, David. I just think it's shifted out by a couple of years. 23, 24, 25. Those can be some real power law years, I think, because we're going to have, just based on what the Fed is saying, 5.5% interest rates for the foreseeable future, which is it's a huge number. The risk, that's a huge.
I'll tell you what that is. You know what it is, though, Chamath? I think to build on your point, and Friedberg, I'll bring you in on after this. It creates an environment in which discipline on all sides of the table, boards, management teams, investors, rank and file, everybody has to be focused. Everybody has to have sharpened swords. And that little bit of headwind and the ability to raise capital being harder is building more reserve and more resilience and grit in this set of founders. It's kind of like parenting in a way. Like if you are too permissive, you give too many options, kids aren't disciplined. And now this group of entrepreneurs I'm seeing who haven't given up, my Lord, are they becoming animals in terms of like pure samurai in terms of how they're running these businesses. Anything that's not efficient, projects that were the third or fourth most important project, cut. Now it's taking them 18 months, Friedberg, to maybe get discipline, but maybe you could speak to the next 3 years and the opportunity for investing in this cohort, because man, that last cohort is going to be really, really challenged, and they'll probably do 6% returns, just like your money market account can do right now, 5 or 6, or what bonds can do. But this next group, man, we're seeing dogged entrepreneurs who are focused on reality, and there is no hallucination now that this is going to be easy. There is no grand delusion here. What are you seeing in the market?
Point about if the market average return in venture and in early stage investing is going to be 6%. Remember, it's not evenly distributed. So 80% of funds could end up having net negative real returns, and 20% make money, and then there'll be a very few that will make real money. And that's the nature of having a very kind of low average return on the industry. Is there may be a lot of wipeouts on the investor class. Folks that have only had 1 or 2 funds and then just got blown up in the cycle. I think there's 2 groups of companies out there. One is companies that obviously have been funded and are doing stuff and are active businesses, and they've raised money in the past. And that's where there's going to be really ugly times. I've mentioned this in the past, but I do think that there's a significant number of these companies that if they were to be truly valued on first principles in private markets today, they'll get valued at a value that's less than their preferred equity, which means that there's a difficult restructuring needed in the company, and not everyone's going to be willing to embrace that. So that's what's going to trigger a lot of the wipeouts in the market. It's not like the businesses are valueless. It's that the capital structure makes it difficult to refund them, to fund them and continue their operations.